The weak market stopped believing. Nothing dramatic announced it. No crash, no shock, just a subtle shift in tone that spread faster than any headline ever could. This story matters now because belief is the real fuel of markets. Prices move not just on data, but on faith that tomorrow will reward today's risk. When that faith weakens, markets don't need bad news to change direction. To understand how confidence can evaporate in days without a single defining event, we need to return to the weak belief quietly left the room. Belief does not announce its departure. It does not write a resignation letter or issue a public statement. It simply stops showing up in the urgency of bids, in the confidence of holding periods, in the willingness to carry a position through uncertainty. And because its absence looks identical to its presence on a price chart, it can disappear almost entirely before anyone names what is missing. It began under familiar conditions. Expectations were aligned. Positions were set. The narrative was intact. Each new session opened with the assumption that normal reactions would resume, and each session closed with something missing. Rallies failed early. Support levels held without enthusiasm. News arrived and passed through the market without impact. Traders felt it before they could explain it. The market wasn't responding. It was withholding. The first reveal came through behavior, not price. Volume thinned during moments that once attracted participation. Risk was reduced ahead of events instead of added. Traders exited trades sooner, not because they were wrong, but because they no longer trusted continuation. Inside institutions, conversations changed. Committees asked whether conviction was still justified. Exposure was reviewed more frequently. Language softened. Certainty gave way to caution. No one declared disbelief, but no one defended belief either. By midweek, the shift was undeniable. The market still moved, but it moved defensively. Strength attracted selling. Weakness failed to inspire buying. Every action assumed fragility rather than resilience. Belief didn't collapse. It stepped aside. And once belief leaves, markets don't behave the same way again. The weak market stopped believing wasn't marked on charts. It was felt in hesitation. And hesitation, when shared widely, becomes direction long before price confirms it. As the week progressed, disbelief spread without conversation. Traders didn't announce their doubts. They acted them out. Positions were trimmed. Exposure was reduced ahead of events. Capital became restless, unwilling to stay committed without conviction. The reveal deepened when volatility failed to behave as expected. It rose during calm sessions and fell during stress. Hedging costs became inconsistent. Protection was harder to price because belief itself had become unstable. The market was no longer anchored by shared expectations. The early conflict emerged when good news lost its power. Data surprised positively, yet prices stalled. Forecasts were raised, yet enthusiasm faded quickly. The disconnect unsettled participants more than bad news ever could. Institutions reacted cautiously. Risk models were adjusted. Scenarios expanded. Assumptions that had held for months were questioned quietly. Exposure wasn't slashed, but it was capped. Growth and risk stopped. The most telling sign was speed. Moves began resolving faster. Trends didn't extend. Every rally felt like an opportunity to exit rather than enter. Belief hadn't reversed. It had thinned. By the end of the week, the market felt different. Not broken, not fearful, just unwilling. Unwilling to assume stability. Unwilling to trust continuation. Unwilling to ignore uncertainty. Belief had not been replaced by panic. It had been replaced by doubt. And doubt, unlike fear, doesn't burn out quickly. It lingers, waiting for proof or punishment. The weak market stopped believing had entered its most dangerous phase. Not collapse, but conditional trust. And conditional trust is fragile. The tension peaked when the market finally tested that conditional trust. A routine event arrived, one that should have reinforced confidence. Instead, it exposed how little belief remained. The conflict intensified immediately. Prices moved sharply, not because the news was bad, but because expectations were thin. Traders who would normally step in hesitated. Liquidity pulled back just enough to matter. The market felt unstable without being extreme. Selling fed on caution rather than fear. Stops triggered quietly. Risk models adjusted automatically. Funds reduced exposure not because they expected disaster, but because they no longer trusted resilience. The assumption that someone else would absorb pressure failed. Correlation spiked. Assets that once offset each other moved together. Diversification weakened at the worst possible moment. The system had synchronized around doubt long before it synchronized around action. Inside institutions, the realization spread fast. This wasn't a technical move. It wasn't a temporary mispricing. It was behavioral. The market had changed its posture. It was no longer leaning forward. It was bracing. Attempts to stabilize sentiment fell flat. Reassurance sounded hollow. Guidance lacked traction. Once belief steps aside, words lose leverage. Only time and proof can restore it. By the end of the move, damage was visible, but not catastrophic. Prices had adjusted. Liquidity returned cautiously. Yet something fundamental had shifted. The market no longer assumed recovery would be immediate. The weak market stopped believing didn't end with a crash. It ended with awareness. Awareness that conviction had been overestimated. And once that awareness settles in, markets don't snap back. They reassess, slowly, selectively, and often painfully. The climax resolved through repricing rather than panic. Markets accepted the absence of belief and adjusted accordingly. Expectations were lowered. Risk was reduced. Time horizons shortened. What had once been assumed now had to be earned. The resolution unfolded as participants adapted to conditional trust. Conviction returned only where evidence justified it. Momentum gave way to selectivity. The system became less forgiving but more honest. In hindsight, the weak had offered warning without destruction. It showed how quickly belief can evaporate and how powerful its absence can be. Not every turning point announces itself with fear. Some arrive through doubt. Modern relevance is constant. Markets today still hinge on belief, still function on shared assumptions, still underestimate how fragile conviction becomes when reactions fail to appear. The lesson isn't to predict collapse. It's to recognize disbelief. Because when markets stop believing, they don't need a reason to move. They only need time. And once belief is gone, it doesn't rush back. It waits for proof or consequence. Subscribe to join the journey. The week that belief departed was significant not only because of what it changed, but because of how it changed it. Belief is not a single, unified thing that either exists or doesn't. It is a layered structure, composed of assumptions about how other participants will behave, about how the system will respond to stress, about whether the narrative that has been supporting prices will continue to hold. When one layer weakens, the others often follow, not simultaneously but sequentially. Each withdraw, making the next one feel more justified. This is what gave the week its particular texture. It did not feel like a collapse. It felt like a gradual recognition, layer by layer, that each of the assumptions sustaining confidence had become less certain than it appeared. The most instructive aspect of this kind of unraveling is that it is invisible to the tools most commonly used to monitor market health. Price levels remained orderly. Volatility, by most measures, was contained. Nothing in the standard metrics declared an emergency. And yet the most important thing happening in the market, the sequential withdrawal of the shared belief that makes collective confidence possible, was progressing steadily beneath all of those metrics, entirely undetected. Only behavior told the truth. Only the shortening of holding periods, the earlier exits, the reluctance to chase strength. Only these revealed what was actually happening. The weak market stopped believing is a reminder that the most consequential market events are often the ones that the standard instruments are least equipped to see. This is an enduring practical implication. Watching behavior, not prices, is the only reliable way to detect a week like this one before it completes its work. The participants who recognized what was happening did so not by analyzing charts, but by noticing how other participants were acting. The hesitation where there used to be urgency, the exits where there used to be entries, the silence where there used to be argument. They noticed that the market's posture had changed from leaning forward into possibility to leaning back away from exposure. And having noticed it, they could position accordingly. not by predicting the direction of the coming move, but simply by reducing the cost of being wrong in an environment where belief had become something that could no longer be assumed. The weak